The Intelligent Investor. I understand how important The Intelligent Investor by Benjamin Graham can be for you, especially if you're interested in the world of investments. It's a valuable resource that has helped many people better grasp the fundamental principles of investing and develop solid strategies for managing their money in the market. If you're reading this book, I recommend immersing yourself in it with attention and reflection. Take your time to absorb the concepts that Graham presents and consider how you can apply them to your own investment approach. Also, don't hesitate to seek clarity in those areas that may seem more challenging or complex. Remember, investing is a journey of continuous learning, and this book is an excellent foundation for building your understanding of how to approach the financial world with intelligence and prudence. The first chapter of The Intelligent Investor establishes a fundamental distinction between investment and speculation. Benjamin Graham emphasizes the importance of understanding the differences between these two approaches. Investment refers to a long-term approach grounded in thorough analysis of a company's fundamentals. Investors seek to buy shares of solid companies at prices they consider below their intrinsic value. Investment involves a commitment to quality and patience, often holding positions for extended periods. Speculation, on the other hand, speculation is more based on short-term price movements and expectations of quick profits. Speculators may be less concerned with a company's fundamentals and more focused on leveraging market fluctuations for rapid gains. Investment guidelines. Know what you're buying. Conduct thorough research on companies you're interested in. Understand their business model, financial statements, and market position. Invest for the long term. Adopt a long-term approach instead of trying to time the market. Maintain a long-term perspective and be patient. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying your portfolio will reduce risk by spreading it across different assets and asset classes. Control your emotions. Avoid being swayed by fear or greed. Keep calm and make rational decisions based on data and analysis rather than emotions. But with a margin of safety, seek to purchase assets below their intrinsic value. This provides a cushion in case of market fluctuations. Keep learning. The financial market is dynamic and always changing. Stay informed, learn from your mistakes, and continuously improve your investment strategies. These principles, based on Benjamin Graham's and other investment experts' principles, can be crucial for any investor seeking to maximize the potential of their long-term investments. In Chapter 2 of The Intelligent Investor, Benjamin Graham addresses the impact of inflation on investments and offers advice on how investors can protect their capital in the long term in an inflationary environment. Impact of inflation on investments. Inflation diminishes the purchasing power of money over time. In an inflationary environment, prices of goods and services tend to rise, meaning the value of each monetary unit decreases over time. This impact can significantly affect investments, as nominal returns may not be enough to surpass inflation and maintain the purchasing power of invested capital. Investment guidelines in an inflationary environment. Invest in real assets. Consider investing in assets that tend to hold their value during inflationary times, such as real estate, commodities like gold or silver, and stocks of companies with tangible assets and solid fundamentals. Inflation index bonds. Some bonds, known as inflation-indexed bonds, adjust their interest payments and principal according to the Consumer Price Index, CPI, helping to protect against the erosion of purchasing power caused by inflation. Stocks of solid companies. Look for stocks of companies with sustainable competitive advantages, solid cash flows, and the ability to raise prices to maintain margins in an inflationary environment. Diversification. As mentioned earlier, diversifying your portfolio among different asset classes can help mitigate the risk of loss of purchasing power due to inflation. Periodic rebalancing. Regularly review your portfolio to ensure it aligns with changing economic conditions, including inflation. Rebalance your investments as needed to maintain a robust strategy. Understanding the impact of inflation on investments and implementing specific strategies can help investors preserve their purchasing power and protect their capital in inflationary environments. In Chapter 3 of The Intelligent Investor, Benjamin Graham addresses the importance of maintaining a balance between risk and caution in investments. Graham emphasizes the need to adopt a prudent and risk-conscious attitude when investing. Balance between risk and caution. Graham argues that investors should maintain a balance between being bold enough to seek investment opportunities and being cautious enough to avoid traps or hasty decisions. Investment guidelines related to the balance between risk and caution. Know your risk tolerance. Understand your own capacity and willingness to accept risks. This will help determine what kind of investments are suitable for you. Diversification. Spread your money across different assets to reduce the overall risk of your portfolio. Don't put all your resources into a single investment. Avoid excessive speculation. Instead of chasing quick gains, focus on solid long-term investments. Excessive speculation can significantly increase the risk of loss. Research before investing. Conduct thorough analysis of any potential investment. Examine the company's fundamentals, market position, and potential for future growth. Stay calm during volatility. Markets can be volatile, but it's essential to stay calm and make rational decisions rather than succumbing to panic or emotion. Plan and diversify your investments. Develop a robust investment plan and diversify your portfolio based on your financial goals and time horizon. The balance between risk and caution is fundamental to a successful investment strategy. Maintaining a balanced perspective can help you make more informed decisions and protect your capital in the long term. In Chapter 4 of The Intelligent Investor, Benjamin Graham discusses the importance of dividends in investments. He focuses on how investors can benefit from regular dividend payments as part of their overall investment strategy. Importance of dividends. Graham highlights that dividends can offer several benefits to investors. Regular income. Dividends provide shareholders with regular cash flows, which can be especially valuable for those seeking stable income from their investments. Signal of financial health. Companies that pay consistent dividends are often seen as financially solid and stable, indicating the company's confidence in its ability to generate sustainable profits. Reinvestment potential. Dividends can be reinvested to purchase more shares of the company, increasing the number of shares and potentially future income. Investment guidelines related to dividends. Invest in companies with a stable dividend history. Look for companies that have a solid track record of paying consistent and increasing dividends over time. Evaluate dividend yield. Dividend yield is the percentage of a stock's current price that represents the annual dividend. Evaluate this indicator in relation to other factors to determine the health and viability of the investment. Seek sustainable dividend growth. Besides the dividend history, consider if the company has the potential to increase dividend payments in the future as it grows. Diversify your dividend portfolio. Don't limit yourself to a single company or sector. Diversify your portfolio with dividend-paying stocks to reduce risk. Reinvest dividends if possible. If your investment goals allow it, consider reinvesting dividends to increase your position in companies and potentially boost future income. Integrating dividend-paying stocks into your portfolio can be a sound strategy, especially if you're seeking regular income and long-term stability in your investments. In Chapter 5 of The Intelligent Investor, Benjamin Graham explores the relationship between the investor and the stock market. Graham introduces the concept of Mr. Market to illustrate market volatility and irrational emotions. Mr. Market. Graham uses a metaphor of Mr. Market, a whimsical character offering to buy or sell stocks at varying prices every day. Sometimes, Mr. Market is optimistic and offers high prices, while other times, he is pessimistic and offers low prices. The key is that the investor is not obliged to follow Mr. Market's oscillations and can capitalize on his irrational fluctuations. Investment guidelines related to Mr. Market. Stay calm in the face of volatility. Don't be swayed by daily market fluctuations. Instead, maintain a long-term perspective and avoid making impulsive decisions based on momentary emotions. Take advantage of market irrationality. When Mr. Market offers excessively high or low prices for a stock compared to its intrinsic value, investors can seize these opportunities to buy or sell accordingly. Avoid trying to predict the market. Attempting to predict exact market movements is risky and generally unpredictable. Instead, focus on fundamental analysis and seek undervalued stocks in relation to their actual value. Invest with a margin of safety. Aim to buy stocks below their intrinsic value to have a cushion in case of market fluctuations. Maintain a long-term strategy. Instead of seeking quick gains, Focus on building a solid portfolio and holding long-term investments aligned with your financial goals. Diversify your portfolio. Diversification can help mitigate the risk associated with market volatility by spreading your investment across different assets. These tips are designed to help investors stay calm amid market volatility, identify opportunities, and build a robust long-term strategy. In Chapter 6 of The Intelligent Investor, Benjamin Graham delves into security analysis, a fundamental aspect for investors. Graham emphasizes the importance of fundamental analysis in evaluating stocks and making informed investment decisions. Security analysis. Security analysis refers to the process of examining a company's financial and business characteristics to determine its worth as an investment. Graham emphasizes some key points in this process. Study of financial statements. Analyze the company's financial statements, such as the balance sheet, income statement, and cash flow. Look for companies with solid financial statements, low debt, and consistent cash flows. Company history and trends. Examine the company's history, market performance, competitive position, and how it has evolved over time. Also, consider future trends and growth potential. Management and leadership. Evaluate the quality and integrity of the management team. Leadership skill and ethics are crucial aspects for the long-term success of a company. Analysis of financial ratios. Use financial ratios like price-to-book (P/B) ratio, price-to-earnings (P/E) ratio, debt-to-equity (D/E) ratio, and others to assess the current value and performance of the company. Investment guidelines related to security analysis. Conduct thorough research. Perform comprehensive research on the companies you're interested in. Examine their fundamentals, industry, competitors, and market position. Understand the business. Don't just focus on the numbers. Understand the company's business model, strategy, and competitive advantage. Be patient and selective. Don't rush into investing in a company. Wait to find opportunities that align with your investment criteria and offer a margin of safety. Keep yourself updated. Stay informed with news and developments in the companies you have invested in or are considering to invest in. The market and companies are constantly changing. Diversify, but with quality. Diversify your portfolio, but don't sacrifice quality for quantity. It's better to have a few solid investments than many low-quality ones. Security analysis is fundamental for making informed decisions in investment. Combining detailed analysis with a long-term perspective can help you build a robust portfolio resilient to market changes. In Chapter 7 of The Intelligent Investor, Benjamin Graham introduces what he calls the magic formula. This formula focuses on identifying stocks that are undervalued in relation to their intrinsic value. The magic formula. Graham proposes a formula to identify stocks that may be considered potentially undervalued investments. This formula is based on two key criteria. Price-to-book ratio (P/B). Graham suggests selecting stocks with a low price-to-book (P/B) ratio, meaning the stock price is relatively low compared to its earnings. Price-to-earnings ratio (P/E). Additionally, he suggests choosing stocks with a low price-to-earnings (P/E) ratio, indicating the stock price is low compared to its earnings. Investment guidelines related to the magic formula and beyond. Understand the formula, but don't limit yourself to it. Graham's proposed formula is a starting point, but isn't the sole factor to consider. Supplement this approach with broader and more detailed analysis of companies. Analyze other financial aspects. Consider other financial and fundamental indicators besides P/B and P/E, such as debt, revenue growth, profit margins, among others. Research the company's health, examine management quality, competitive position, growth prospects, and sector stability. Don't neglect diversification, even while seeking undervalued stocks. Avoid putting all your money in a limited number of investments. Diversification remains key to mitigating risk. Maintain patience and discipline. Sometimes, the market may take time to recognize a company's true value. Maintain a long-term perspective and don't be discouraged if results aren't immediate. Continuous learning. The financial world and companies are constantly changing. Stay updated and continually enhance your knowledge of investment strategies. Graham's magic formula provides an interesting starting point to identify undervalued stocks. but it's crucial to complement this approach with a broader and more detailed analysis of companies to make informed and prudent investment decisions. In Chapter 8 of The Intelligent Investor, Benjamin Graham focuses on selecting securities for the investment portfolio. This chapter deals with constructing a solid and balanced portfolio through careful asset selection. Security selection for the portfolio. Graham emphasizes several key points in selecting securities for a well-diversified and balanced portfolio. Diversification suggests distributing the portfolio across different asset classes and companies from different industry sectors to reduce risk. Bond investment. Consider including bonds in your portfolio to balance the risk associated with stocks. Bonds can provide stability and predictable cash flow. Stock selection. Focus on stocks from solid companies with good fundamentals, stable earnings, a proven track record, and a strong dividend history if seeking regular income. Periodic rebalancing. Regularly review your portfolio to adjust it according to market conditions, changes in investment goals, and to maintain diversification. Investment guidelines related to security selection for the portfolio. Set clear investment goals. Define your financial objectives and time horizon. This will help determine the appropriate asset allocation in your portfolio. Don't put all eggs in one basket. Diversify your portfolio to mitigate risk. Investing in different asset classes and sectors can help protect your portfolio from market fluctuations. Consider active or passive management. Decide whether you prefer an active management strategy, selecting individual stocks, or passive, investing in index funds or ETFs. Regularly review and adjust your portfolio. Keep an eye on your portfolio and adjust the asset allocation as necessary. This ensures alignment with your goals and market conditions. Consider taxes and costs. Factor in the tax implications of your investments and minimize costs associated with buying and selling assets. Careful security selection and constructing a diversified and balanced portfolio are crucial for a solid and prudent investment strategy. Regularly evaluating your portfolio and adjusting it as needed is critical to keeping it aligned with your long-term financial goals. In Chapter 9, The Future of the Intelligent Investor, Graham offers reflections on adapting the principles of the intelligent investor to a changing environment and evolving market. Some general investment advice that can be useful when considering the future in your financial decisions. Long-term focus. Maintain a long-term perspective when investing. Avoid the temptation for quick gains and keep your investments aligned with your long-term financial goals. Adaptability. The financial and economic world is constantly changing. Stay abreast of trends and market changes to adapt your investment strategy as needed. Continued diversification. Keep diversifying your portfolio as your financial goals, risk tolerance, and market conditions change. Diversification helps mitigate risk. Emotional resilience. Learn to control emotions while investing. Avoid impulsive decisions based on market panic or euphoria and make informed and rational decisions. Continuous education. Keep learning about investments and personal finance. Financial education will help you make more informed decisions and navigate markets better. Periodic reassessment. Review and adjust your portfolio periodically. Reassess your goals, verify your investment alignment, and make necessary changes. Consider professional advice. At times, seeking guidance from a financial advisor can be beneficial, especially when facing complex decisions or uncertain about your strategy. These tips, combined with the solid investment principles presented by Benjamin Graham throughout his book, can help you develop a stronger and more resilient investment strategy to tackle future challenges and opportunities in the financial world. The Intelligent Investor is a foundational work that has left a lasting imprint on the investment world. Here are some additional important points that could be valuable. Contrarian mindset. Graham emphasizes the importance of adopting a contrarian mindset when investing. This means being cautious when others are greedy and being bold when others are panicking. Being able to maintain a different perspective from the market can be an advantage. Risk management importance. Beyond asset selection, Graham emphasizes risk management. This includes diversification, constant evaluation, and adjustments as necessary to protect your capital. Learning from mistakes. Recognizing and learning from mistakes is an essential part of the investment process. Not all decisions will be correct. But understanding why they failed and how to improve is key to growth as an investor. Difference between investment and speculation. Graham clearly distinguishes between investment and speculation. He insists that investment is based on fundamental analysis, while speculation focuses more on short-term expectations without necessarily considering fundamentals. Graham's formula is a guide, not a rule. Graham's valuation formula is an approach, not an infallible rule. It's important to supplement it with deeper analysis and be willing to adapt to market circumstances. Emphasis on independence and autonomy. Graham advocates for independent thinking and autonomy in making investment decisions. He suggests investors should not rely solely on others' opinions, but form their own conclusions based on fundamental analysis. Thank you for joining this exploration of the intelligent investor. Remember, knowledge is the first step towards change. Now, I invite you to share in the comments which lesson impacted you the most. Don't forget to subscribe for more content on financial education and personal development. Together, we'll build a path to financial freedom. See you in the next video.